Today we're doing a complete breakdown of share-based payment full concept plus interview questions. International Financial Reporting Standards 2, ASC 718, Indian Accounting Standard 102. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying International Financial Reporting Standards or Indian Accounting Standard or ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before these standards, companies could grant stock options without showing the real expense. Imagine a tech firm giving $10 million in options with no impact on the income statement. Now, with International Financial Reporting Standards 2, ASC 718, and Indian Accounting Standard 102, companies must recognize these costs transparently, impacting both earnings and investor decisions. International Financial Reporting Standards 2, ASC 718, and Indian Accounting Standard 102 emerged to address a significant gap in financial reporting. These standards ensure that the cost of share-based payments is accurately reflected in financial statements, preventing companies from inflating profits by ignoring these expenses. Before these standards, stock options could be issued without showing any associated cost. Now companies must report these costs, providing a more truthful picture of their financial health. This transparency aids investors in making informed decisions. International Financial Reporting Standards 2 and its equivalents, ASC 718 and Indian Accounting Standard 102, are mandatory for any company issuing share-based payments, whether to employees or external parties. Effective since 2005, these standards require recognizing the expense over the vesting period, aligning it with the delivery of services. This means if an employee is awarded options that vest over 4 years, the expense is spread over that period, ensuring that financial statements more accurately reflect the company's economic activities. The Fair Value Measurement Model is central to International Financial Reporting Standards 2, ASC 718, and Indian Accounting Standard 102, requiring companies to estimate share-based payment costs by considering market conditions. Instead of using the outdated intrinsic value approach, which often underestimated costs, this model uses factors like stock volatility and expected option life. This ensures that the financial statements reflect the true economic impact of these transactions. Understanding this model is crucial for interviews, as it highlights your grasp of accurate financial reporting. Understanding the scope of International Financial Reporting Standards 2 is critical because missing an exclusion can lead to costly errors. Candidates often overlook that transactions unrelated to employee compensation fall outside the standard, a classic interview trap. International Financial Reporting Standards 2 covers transactions where companies issue shares or cash linked to shares for services. This applies to both employees and non-employees. For instance, a company granting stock options to a consultant must recognize this under International Financial Reporting Standards 2, affecting how it reports expenses. International Financial Reporting Standards 2 does not cover payments for non-compensation goods or services, like acquiring inventory. It excludes non-share transactions, such as paying cash bonuses. Misapplying these exclusions often trips up candidates in interviews. Properly distinguishing these ensures accurate financial reporting. A share-based payment occurs when a company exchanges shares for services. Consider a company granting stock options to employees as compensation. This requires recognizing an expense equal to the fair value of the options, impacting earnings. Understanding this definition is crucial for accurate financial statements. Equity instruments, like shares or options, represent ownership in a company. When a company issues stock options as part of compensation, it impacts ownership structure and potentially dilutes existing shareholders. Understanding these instruments is essential for assessing a company's financial health and strategic decisions. Navigating edge cases tests your grasp of International Financial Reporting Standards 2. Consider stock options given to contractors. They are included. Payments for non-share-related services and cash bonuses are not. Distinguishing these scenarios ensures precise application of financial standards and prepares you for challenging interview questions. Imagine a tech startup offering stock options to attract talent. Without the fair value measurement model, these could be wildly over or undervalued. This model anchors financial reports to reality, ensuring a $500,000 option grant reflects true economic cost. It's the backbone of International Financial Reporting Standards 2, ASC 718, and Indian Accounting Standard 102, driving consistent, fair accounting across businesses. The fair value measurement model is all about transparency and comparability. Take a company like Techsoft, issuing $1 million in stock options. This model ensures these options reflect true market value, impacting earnings accurately. By aligning accounting standards globally, it prevents discrepancies in reporting financial health, helping investors assess companies reliably. Identifying the share-based payment arrangement is crucial. Imagine Dynamics Incorporated mistaking a cash bonus tied to stock value for an equity grant. This leads to misreported liabilities and distorted financials. Recognizing whether a transaction involves actual equity or mimics its value underpins accurate financial reporting and compliance with International Financial Reporting Standards 2 and related standards. Determining fair value is where precision counts. Consider Beta Corporation, which uses Black-Scholes to value 5,000 options at $12 each. This sets the baseline for recognizing compensation cost. Misjudging market conditions here skews expense recognition, affecting profitability reports. Accurate fair value estimation is non-negotiable for compliance and investor trust. Recognizing expenses over the vesting period ensures smooth financials. Consider Omega Corporation, which spreads $900,000 in stock option costs over 4 years, matching employee service. Misallocation here can lead to financial spikes, misinforming stakeholders. Proper allocation aligns reported expenses with actual service periods, reinforcing transparency and compliance with standards. Adjustments for modifications can significantly impact financials. When Acme Incorporated changes option terms, boosting fair value by $100,000, reevaluation is crucial. Failing to adjust means outdated, misleading reports. This step ensures companies reflect real-time changes, maintaining accurate and transparent accounting practices in line with International Financial Reporting Standards and ASC standards. Accounting for tax effects is where many slip. Picture Nova Incorporated, which records $30,000 in deferred tax assets linked to stock options. Missed tax adjustments distort financial realities, impacting both tax obligations and net income. Properly accounting for tax differences ensures accurate financial portrayal and compliance with crucial accounting standards. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. Precise initial and subsequent valuations matter. Missed disclosures aren't just technicalities, they can obscure significant financial realities. Here's the nitty-gritty of ensuring accuracy and transparency in your financial statements. Initial recognition sets the stage for accurate financial reporting. Recognize share-based payments when the counterpart renders services. For goods or services received, measure at fair value on the grant date. Equity-settled transactions increase equity, while cash-settled ones are reassessed at each reporting period. If fair value eludes, use intrinsic value initially. This foundational step is crucial for transparency and accuracy. After initial recognition, understanding what changes and what doesn't is key. Equity-settled transactions stick to their initial fair value. No remeasurement needed. Cash-settled transactions, however, demand constant revaluation, ensuring liabilities reflect current realities. This revaluation directly affects profit or loss. Keep a keen eye on non-market vesting conditions, as they can shift the quantity of equity instruments expected to vest, altering financial outcomes. How share-based payments appear in financial statements is critical for understanding financial health. Equity-settled payments enhance shareholder equity and sit under equity in the balance sheet. Conversely, cash-settled payments impact liabilities, either current or non-current. Expenses hit the income statement, typically under staff costs. Don't overlook the notes. They're where the real detail lies, highlighting key arrangement terms and conditions. Transparency is the name of the game in disclosures. Share-based payment expenses must be clear in the income statement, as they directly influence performance assessments. provide a deep dive into the nature and scope of these payment arrangements to evaluate management strategy. Valuation methods and their assumptions need full transparency for trust and recorded values. Finally, report on the number and weighted average exercise prices of outstanding options to truly gauge potential equity dilution. Picture a CFO navigating a $3 million equity-settled share-based payment. It boosts equity, locked at initial value, no remeasurement. For cash-settled payments, she diligently reevaluates a $2 million liability quarterly, ensuring market conditions are reflected. Detailed disclosures and financial notes keep stakeholders informed about the equity and liability impacts. Her explanations of valuation methods and assumptions illuminate the financial statement's reliability, fostering stakeholder confidence. Recruiters always ask, what changes if your client follows international financial reporting standards instead of U.S. generally accepted accounting principles? Here's exactly where they split. Understanding these nuances can make or break your interview. Dive deep into specifics like valuation methods and stock purchase plans to stand out. Scope is the first battleground for differences. International Financial Reporting Standards 2 covers a wide range of share-based payments, ensuring comprehensive reporting. Indian Accounting Standard 102 aligns closely with this approach, but ASC 718 carves out certain equity instruments. Knowing these distinctions can guide accurate financial reporting and compliance. Recognition timing can shift reported expenses significantly. With International Financial Reporting Standards 2, if options vest immediately, the expense hits right at grant. Indian Accounting Standard 102 mirrors this stance, but ASC 718 delays recognition until the service period starts, impacting income statements differently. This can change financial metrics during critical reporting periods. Measurement can alter reported values by millions. International Financial Reporting Standards 2 mandates fair value at grant date, focusing on a market-based approach. Indian Accounting Standard 102 offers flexibility, allowing different methods. ASC 718 aligns with fair value, but provides detailed guidance for employee stock purchase plans, ensuring consistency in U.S. generally accepted accounting principles reporting. Presentation and disclosure dictate transparency. International Financial Reporting Standards 2 demands extensive details on share-based payments, ensuring stakeholders understand impacts. Indian Accounting Standard 102 aligns closely with these requirements. ASC 718 also demands transparency, but its format and content requirements may differ, necessitating tailored disclosures for U.S. generally accepted accounting principles compliance. Get ready for those rapid-fire interview questions. Know the valuation mandates. International Financial Reporting Standards 2 insists on market-based calculations, while Indian Accounting Standard 102 offers flexibility. Recognition timing in ASC 718 starts with the service period, contrasting International Financial Reporting Standards 2's grant date focus. Disclosures vary, so tailor them per framework's unique demands. Meridian Corporation, a leading multinational in electronics, grants stock options to key executives as part of their compensation package. Witness how these options flow through the financials, impacting everything from expense recognition to equity accounts over the entire vesting period. The initial grant of stock options sets the stage for recording compensation expense. According to International Financial Reporting Standards 2, expense is recognized over the vesting period. Meridian Corporation records $100,000 as a share-based payment reserve, balancing it with an equivalent compensation expense, signaling the cost of future potential stock issuance. Each year, Meridian Corporation must recognize a portion of the total option grant as an expense. For the first year, $25,000 is recorded in both compensation expense and the share-based payment reserve. This ensures the gradual recognition of the total cost of executive incentives over the vesting period, aligning with International Financial Reporting Standards requirements. The second year sees another $25,000 recognized as compensation expense, maintaining the consistent allocation of the $100,000 grant over the 4-year vesting period. This journal entry upholds the principle of matching costs with the vesting service period required from executives, ensuring accurate financial reporting and compliance. For the third year, Meridian Corporation records another $25,000 of expense. This consistency in recognition ensures the financial statements reflect the accruing cost of executive compensation accurately. Following International Financial Reporting Standards guidelines, Meridian meticulously allocates the option grant to match the ongoing service requirement. With the final year's $25,000 recognized, Meridian completes the vesting cycle, ensuring all option-related expenses have been matched to the periods benefiting from executive service. This practice reflects a disciplined adherence to international financial reporting standards, capturing the financial impact of non-cash compensation in a structured manner. When executives exercise options, the related reserve is reallocated to share capital accounts. Meridian shifts $50,000 from share-based payment reserve to share capital for 5,000 options exercised, reflecting the equity increase from this non-cash compensation realization. This transfer highlights the culmination of executive incentives into tangible equity changes. At the end of the option lifecycle, any unexercised options are transferred from the share-based payment reserve to retained earnings. Meridian Corporation records a $50,000 transfer, reflecting the lapse of these options and the resultant increase in retained earnings, finalizing the share-based payments impact on equity. Every Big Four and investment bank interview on share-based payment full concept, plus interview questions, International Financial Reporting Standards 2, ASC 718, Indian Accounting Standard 102, follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. A share-based payment is a transaction in which an entity receives goods or services as consideration for its equity instruments. Companies use it to align employee interests with shareholders, reduce cash outflows, and incentivize performance. Understanding fair value measurement is crucial here, as it avoids trap 1, confusing it with intrinsic value. Memorize. Fair value reflects market conditions at grant date, crucial for accurate reporting. Companies recognize share-based payment expenses over the vesting period. For example, if an option vests over 4 years, the cost is spread equally across each year. This approach avoids the mistake of recognizing it all at once, leading to smoother financial statements. Remember, consistent expense recognition aligns with service periods and avoids overstating annual expenses. Indian Accounting Standard 102 largely mirrors International Financial Reporting Standards 2, but emphasizes disclosure requirements and fair value measurement precision. While International Financial Reporting Standards 2 allows some flexibility in valuation models, Indian Accounting Standard requires more detailed disclosures. This prevents inconsistencies across Indian contexts. Key takeaway: understand local adaptations to avoid misinterpretations, especially when moving between international and Indian reporting frameworks. Calculating fair value involves using models like Black-Scholes or binomial models, incorporating volatility, risk-free rate, and expected dividends. For instance, a share with high volatility will have a different valuation compared to a stable one. Avoid trap 1, using intrinsic value instead of fair value. Memorize. Accurate input assumptions are vital for precise fair value computation. Tax implications can vary significantly. Generally, the expense recognized for accounting purposes doesn't match the tax deduction. For example, the tax deduction might depend on intrinsic value at exercise, leading to deferred tax assets or liabilities. Avoid trap 3, overlooking these discrepancies. Key takeaway: align tax strategies with accounting policies to optimize tax benefits. Not all are covered. International Financial Reporting Standards 2 excludes intragroup payments and cash-settled share-based payments without equity instruments. Misunderstanding this can lead to incorrect application. For instance, treating intragroup transactions incorrectly could misstate financials. Takeaway: always check the nature of the transaction against scope exceptions to ensure correct application. Disclosure requirements include detailed information on the nature and extent of share-based payment arrangements, their impact on financial statements, and assumptions used in fair value calculations. For example, companies must disclose assumptions like expected volatility and dividends. Avoid omitting key assumptions, as it misleads users. Memorize. Transparency in disclosures enhances stakeholder confidence and compliance. Modifications can change expense timing and amount. For instance, if vesting conditions are altered, recalculation is required. This prevents overstated or understated expenses. Avoid trap 2, thinking modification doesn't affect recognition. Key takeaway: reassess fair value and service period impact to ensure accurate financial reporting. ASC 718 and International Financial Reporting Standards 2 differ mainly in tax accounting and disclosure. ASC emphasizes tax effects and requires recognition of deferred tax assets for all deductible temporary differences. International Financial Reporting Standards focuses more on fair value measurement. Misunderstanding tax implications can lead to reporting errors. Memorize. Align disclosures with respective standards for accurate compliance. Fair value often reflects market value but can differ due to model inputs like volatility and risk-free rate. Market value is a single point, while fair value considers more variables. Avoid assuming they are interchangeable, as this leads to incorrect valuations. Takeaway: understand model assumptions affecting fair value to avoid costly errors. Understanding the basics of share-based payments is vital. These transactions enhance alignment between company and employee interests and must be recognized in financial statements. They include equity and cash-settled transactions, each with unique accounting treatments. Grasp key terms like grant date and vesting periods to navigate International Financial Reporting Standards 2, ASC 718, and Indian Accounting Standard 102 effectively. Remember, recognition occurs when services are received or liabilities incurred. The core measurement model is centered on fair value. Equity-settled transactions are valued at grant date, using market-based measures. Key factors like market conditions are part of this initial measurement. However, service and performance conditions mainly affect recognition timing. Cash-settled awards are remeasured frequently. Expense recognition occurs over the vesting period, capturing the cost of services received. Modifications can alter expense patterns and require careful handling. Acing share-based payment questions hinges on mastery of distinctions like service versus performance conditions. Be clear on how international financial reporting standards and U.S. generally accepted accounting principles diverge in treating modifications, and know disclosure mandates inside out. Avoid classification errors between cash and equity-settled transactions. Explain expense patterns across vesting periods with confidence. Discuss the impact of modifications on financials, and highlight the grant date's critical role in valuation. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.